I learned early, too early for my liking, that the market does not reward activity. It rewards judgment. Yet most traders, when they first come to this business, believe the opposite. They think the man who trades the most must surely know the most. Have you noticed that? They sit before the tape or the chart, as if stillness were a crime, as if money leaks away when the hands are idle. I was that man once, and I paid tuition for it, paid dearly. The market is always open to temptation. There is always a little move here, a twitch there, something that looks as if it might turn into a profit if only you are quick enough. But quickness is a poor substitute for understanding. Do you really think the market owes you a living just because you showed up today? I found that every extra trade I made without a sound reason was not a chance to win, but a chance to make a mistake. The trouble with trading too much is not only the commissions or the losses, though those add up fast enough. The real damage is to the mind. Each needless trade blurs your judgment a little more. You stop seeing the big picture and begin to argue with the tape. Instead of listening, you start talking back to the market. And the market, I assure you, does not care to hear your arguments. I have always said that it was never my thinking that made the big money for me. It was my sitting. That sitting was not laziness, it was discipline. I waited until the market showed its hand plainly. Most traders cannot wait. They want action. They want to feel involved. But tell me, is feeling involved the same thing as being right? The market pays only for being right, and only when you act at the right time. Overtrading often comes from fear. Fear of missing out. Fear of being wrong. Fear of doing nothing. Doing nothing feels dangerous to the beginner. They think, what if this is the move and I'm not in it? But what if it isn't? What if it's just another small fluctuation designed to shake out impatient money? The market has a way of punishing the trader who must always be doing something. Charts, when read properly, do not shout. They whisper. They tell their story slowly, bar by bar, trend by trend. When you trade too much, you stop listening to that story. You jump in mid-sentence and assume you know how it will end. How often has that assumption cost you? I learned that the big money comes when a trend is established and confirmed, not when it is guessed at. There were long stretches when I did almost nothing. I watched prices move within narrow ranges, up a little, down a little, going nowhere with conviction. Those were not times to trade. They were times to prepare. Preparation is quiet work. It doesn't feel heroic. But when the market finally breaks from a range and shows real intent, the prepared trader acts with confidence, not haste. Too many trades also mean too many opinions. Each position demands emotional energy. You begin to hope, to fear, to justify. Soon your account is full, but your head is even fuller. Can a man think clearly when he is pulled in 10 directions at once? I found that holding fewer positions, taken for solid reasons, kept my mind clear and my judgment sharp. The public likes excitement, and overtrading provides plenty of it. But excitement is not a trading asset. Calm is. The best trades I ever made felt almost boring when I entered them. The market was doing exactly what it should have been doing, and all I had to do was follow along. When I felt bored, I was usually right. When I felt excited, I was usually about to be wrong. There is also a moral element to this business, though few speak of it. Overtrading is a kind of dishonesty with oneself. It is pretending that every wiggle is an opportunity when you know deep down that it is not. It is forcing trades because you want results now, not because the conditions justify them. Ask yourself honestly, am I trading the market, or am I trading my impatience? Money management suffers when trading becomes excessive. Small losses pile up, not because any single trade was disastrous, but because there were too many of them. A trader who waits can place his risk precisely, knowing where he is wrong. A trader who jumps at everything is wrong in a dozen ways at once and cannot tell which mistake matters most. The longer I stayed in this game, the more I respected restraint. I learned that missing a trade never hurt me as much as forcing one. The market will always offer another chance, but it will not forgive recklessness. Do you really believe this is the last opportunity you'll ever see? That belief alone is enough to empty an account. A sound trading mindset accepts that cash is a position. Waiting is not weakness, it is strategy. When conditions are unclear, the proper action is inaction. That idea runs against human nature, which is why so few can follow it. But the market rewards those who can master themselves before trying to master prices. I have watched traders burn themselves out by trying to catch every move. They knew all the patterns, all the indicators, yet they could not stop pulling the trigger. Knowledge without restraint is useless. It is not what you know that counts most, but what you can refrain from doing. In the end, the lesson is simple, though not easy to live by. Trade less. Think more. Wait for the market to line up with your judgment, not the other way around. If you cannot sit on your hands when there is nothing to do, this business will teach you that lesson with real money. Most men come into the market believing that motion equals mastery. They see the ticker moving, the candles forming, prices lifting and dipping, and they feel an urge to participate. To them, activity feels like intelligence. If they are busy, they must be learning. If they are trading, they must be doing something right. I once believed the same thing, and the market corrected me without mercy. The truth is that activity and speculation is often nothing more than nervous energy looking for an excuse. A man who does not know what to do will usually do too much. He confuses motion with progress. Have you ever noticed how the busiest traders are rarely the calmest ones? They are forever adjusting positions, chasing small moves, reacting to every tick as if it were a signal from above. Yet the market does not reward the man who reacts fastest. It rewards the man who understands best. Intelligence in trading is shown not by how often you trade, but by how selective you are. A sound trader does not feel compelled to act just because the market is open. He waits for conditions that justify action. That waiting is not passive. It is deliberate. It is observation with purpose. But to the untrained eye, it looks like doing nothing, and doing nothing makes people uncomfortable. Charts do not improve because you stare at them all day. Price does not behave more clearly because you click the buy or sell button repeatedly. The market will reveal its intentions in its own time, not according to your schedule. When a trader mistakes activity for intelligence, he begins to force meaning into meaningless movements. He starts trading noise and calling it insight. I have seen men who could not stand the quiet moments. When the market drifted sideways, they felt ignored. They thought, surely there is money to be made here if I'm clever enough. But cleverness cannot extract profit from indecision. Sideways markets are the market telling you to wait. The intelligent trader listens. The active trader argues. There is also pride involved. Many traders equate inactivity with ignorance. They worry that if they are not trading, they are falling behind others who are. But this is a solitary business. You are not competing with the man next to you. You are competing with your own weaknesses. Ask yourself honestly, are you trading because you see something clearly, or because you don't want to feel left out? The market is a patient teacher, but it charges tuition for every lesson. One of the first lessons it teaches is that most trades are unnecessary. Only a few moments each year truly matter. The rest of the time is preparation, observation, and restraint. When a man understands this, his trading slows down, but his results improve. His account stops bleeding from 1,000 small cuts. Activity becomes dangerous when it replaces thinking. A trader who is constantly in motion has no time to reflect. He does not review his decisions. He piles new ones on top of old mistakes. Each trade feels justified in the moment, but taken together, they form a pattern of confusion. Intelligence requires clarity, and clarity requires space. There is a reason the biggest moves begin quietly. Before a trend announces itself, it builds pressure. Volume behaves differently. Ranges tighten. The intelligent trader notices these changes and waits for confirmation. The active trader jumps in early, convinced that being first is the same as being right. How often has being early felt exactly like being wrong? True intelligence in trading shows itself in risk control. A man who trades less can define his risk more precisely. He knows where he is wrong before he enters. A man who trades constantly spreads his risk across dozens of positions, none of them well thought out. He believes he is diversified, but in truth he is just distracted. I learned that the market does not care how hard you work. You can study all night, trade all day, and still lose money if your activity is misdirected. The tape rewards accuracy, not effort. It pays for correct interpretation, not enthusiasm. Once I accepted this, I stopped trying to prove myself to the market. Many traders use activity to avoid responsibility. If they are always trading, they can blame losses on bad luck, fast markets, or unexpected news. But when you trade selectively, every decision carries weight. You cannot hide from your mistakes. That accountability sharpens judgment, but it frightens those who prefer constant motion. Intelligence also means knowing when conditions are unfavorable. Not every market environment is tradable. Sometimes volatility is too low, sometimes too erratic. The intelligent trader recognizes these periods and stands aside. The active trader insists on extracting profit anyway, and in doing so, he feeds the market with his capital. The market is not impressed by your opinions. It does not reward confidence alone. It rewards alignment. When your analysis aligns with the market's behavior, action is warranted. When it does not, restraint is the higher form of intelligence. But restraint feels invisible, and invisible skills are hard for beginners to value. I have always believed that the hardest thing in speculation is not learning how to trade, but learning when not to. Activity offers comfort. It creates the illusion of control. Intelligence requires surrender to the idea that the market sets the terms, not you. A trader who understands this begins to measure success differently. He no longer counts trades, he counts quality decisions. He does not ask how much action he had today, but whether the market offered him anything worth acting on. That shift alone separates the professional from the amateur. There is a special kind of pain that comes from watching a market move without you. Every trader knows it. You see the price advance in the very direction you studied, the direction you expected, and yet you are standing aside. The move unfolds cleanly, almost politely, and your first thought is not relief but regret. You tell yourself you should have acted sooner. But that feeling, unpleasant as it is, costs far less than the pain of forcing a trade that never should have been made. Missing a trade wounds the ego. Forcing a trade wounds the account. The difference between the two is everything. Ego heals quickly. Capital does not. I learned that lesson slowly, because like most men, I preferred emotional discomfort over admitting restraint was the wiser course. Have you ever noticed how quickly traders forgive themselves for bad trades if at least they were involved? The market does not punish you for missing opportunities. It simply moves on. It offers another setup in time, another chance under different conditions. But it is relentless with those who force their hand. When you enter without confirmation, without alignment, without patience, the market becomes a judge with no sympathy. It does not care that you were afraid of missing out. It only cares that you were wrong. Most forced trades are born from imagination, not observation. The trader sees what he wants to see. A small uptick becomes the start of a major move. A minor pullback becomes the perfect entry. He convinces himself because he wants to be in the market, not because the market is inviting him in. That desire is expensive. The tape has a way of exposing hopeful thinking very quickly. I have missed many trades in my life. Some of them went on to become large moves. At the time, it felt like a failure of nerve. But when I looked back honestly, most of those missed trades did not meet my standards at the moment they appeared. They became obvious only after the fact. And hindsight, as you know, is the most persuasive liar in the business. Forcing a trade often feels brave. It feels decisive. The trader tells himself that hesitation is weakness and that boldness will be rewarded. But speculation is not a test of courage, it is a test of judgment. Acting without sufficient evidence is not boldness. It is impatience dressed up as confidence. Ask yourself, how many times has courage saved a poorly timed trade? The market operates on probabilities, not certainties. Your job is not to catch every move, but to participate when the odds are clearly in your favor. When you miss a trade, you lose only the potential profit. When you force one, you accept real risk without real advantage. That is an uneven bargain, and the market is full of traders who make it daily. There is another danger in forced trading that is less obvious but more damaging. It conditions bad habits. Each forced trade that does not immediately punish you encourages repetition. You begin to believe your impatience is skill. Then, when the market finally turns against you, it does so with compounded force. One mistake stacked upon another becomes a pattern, and patterns are hard to break. Missing a trade, on the other hand, can sharpen discipline if you let it. It teaches you to wait for clarity. It reinforces your rules. It reminds you that opportunity is not scarce, but capital is. A trader who learns to accept missed trades develops emotional balance. He stops chasing and starts selecting. I found that the traders who suffered most were not those who missed moves, but those who could not stand to miss them. Their fear of being left out drove them into poor positions at poor prices. They entered late, exited early, and blamed everything except their own impatience. The market did not ruin them, their need to participate did. There is no bell that rings when a valid trade appears. There is only alignment, price, trend, volume, and timing coming together. Sometimes that alignment forms while you are watching, sometimes while you are not. You cannot control that. What you can control is whether you demand perfection before risking your money. Forced trades lower that standard, and once lowered, it rarely rises on its own. I learned to measure success not by how many trades I caught, but by how many bad trades I avoided. That shift changes everything. When avoiding loss becomes more important than chasing gain, your behavior adjusts naturally. You stop feeling pressured by every move. You let the market prove itself before you commit. Many traders believe that action creates opportunity. In truth, opportunity exists independently of you. It does not disappear because you missed it. But capital disappears quickly when you act without reason. That is the imbalance most never correct. Missing trades is a cost you pay in imagination. Forcing trades is a cost you pay in reality. One keeps you intact for the next opportunity. The other weakens you before it arrives. Small losses are easy to dismiss. That is why they are so dangerous. A trader rarely fears them at first. He shrugs them off as the cost of doing business, as if they were harmless tolls paid along the road to success. One small loss does not feel important. Two barely register, but the market does not count them the way you do. It adds them up quietly, relentlessly, until the total tells a story you were too busy to notice. Overtrading is the perfect machine for manufacturing small losses. Each trade seems reasonable in isolation. The chart looked acceptable. The risk felt manageable. The loss, when it came, was minor. But repetition changes the nature of things. What is small once becomes serious when repeated often enough. Have you ever noticed how rarely traders stop after the first unnecessary loss? The problem is not that traders take losses. Losses are unavoidable. The problem is that overtrading creates losses that serve no purpose. They do not come from well-considered judgment that turned out wrong. They come from impatience, boredom, or the need to feel involved. Those losses teach nothing. They simply drain capital and dull perception. A trader who trades too often is always exposed. He never has a moment of safety. The market does not need to make a large move against him to do damage. It only needs to be choppy, uncertain, and indifferent. In such conditions, small losses appear everywhere. Each one feels manageable, but together they form a steady leak, and a steady leak will sink any account given enough time. What makes these losses especially destructive is how they affect confidence. A single large loss is shocking, but it is clear. A series of small losses is confusing. The trader begins to doubt his ability to read the market. He tweaks his approach, changes his timing, adjusts his indicators. Each adjustment leads to another trade, and often another small loss. The cycle feeds itself. I have seen traders survive a major setback and recover, only to be ruined later by a long stretch of overtrading. They never realized what was happening. They were too focused on the next trade to examine the cumulative effect of the last 10. The account balance told the truth, but they refused to listen. Small losses multiply fastest when trades are taken without strong conviction. When you are unsure, you exit quickly. You cut trades early, sometimes correctly, sometimes not. But uncertainty breeds inconsistency. You never let the market work. You grab at small profits when you can and accept small losses when you must. The result is a pattern of constant friction. There is also the hidden cost of commissions and slippage. Individually, they seem trivial. But overtrading magnifies them. The market takes its share every time you act, whether you win or lose. When you trade excessively, you pay that price again and again. The market does not care that your losses were small. It only cares that you participated. Overtrading also shortens your emotional fuse. Each small loss adds irritation. Each irritation pushes you closer to a poor decision. By the time a truly good opportunity appears, you are tired, distracted, or overly cautious. You hesitate when you should act, or you act recklessly to make back what you lost earlier. Either way, the earlier small losses have already done their damage. The trader who waits trades with intention. His losses, when they occur, are meaningful. They represent a hypothesis tested and rejected. The overtrader's losses are noise. They represent nothing but motion. And noise, repeated often enough, overwhelms signal. I learned to respect the arithmetic of this business. 5 losses of 1% do not feel dramatic, but they are not harmless. They reduce capital, yes, but more importantly, they reduce flexibility. Each small loss limits future choices. Position size shrinks, patience erodes, pressure increases. All of that comes from losses that once seemed insignificant. Many traders believe they are being prudent by keeping losses small while trading frequently. They mistake frequency for control. In reality, control comes from selectivity. Fewer trades mean fewer opportunities to be wrong. When you trade less, each decision carries weight. That weight forces clarity. Overtrading removes that pressure and replaces it with constant exposure. The market is unforgiving to those who bleed slowly. It allows them to continue long enough to believe they are managing risk, all while capital drains away. By the time they realize what has happened, they are no longer trading from strength. They are trading from necessity. I began to understand that preservation of capital is not just about avoiding large losses. It is about avoiding unnecessary ones. The quickest way to lose money is not to make a bold mistake, but to make many small ones without purpose. Overtrading guarantees that outcome. Too many positions create the illusion of control. A trader feels safer when he is spread across several trades, as if quantity itself were protection. He believes that by holding many positions, he is reducing risk. In reality, he is often multiplying it. Each position demands attention, judgment, and emotional energy. When there are too many, none receive the care they require. Clear thinking in trading depends on simplicity. The more positions you hold, the more stories you tell yourself. Each chart has its own logic, its own reasons for being in the trade. Soon your mind is juggling narratives instead of weighing probabilities. Have you noticed how difficult it becomes to explain your overall exposure when your account is full? A trader with 1 or 2 well-chosen positions knows exactly why he is in them. He knows what must happen for him to be right and what will prove him wrong. A trader with 10 positions often cannot answer those questions without hesitation. He relies on hope to fill the gaps. Hope is not analysis. It is a substitute for it. The market does not see your positions individually. It sees them in relation to each other. Correlation hides in plain sight. What appear to be separate trades often move together under stress. When the market turns, everything moves at once. The trader who thought he was diversified discovers that he was simply overextended. Mental capital is just as real as financial capital. Each open position draws from it. Decisions become slower. Reactions become emotional. You spend more time managing existing trades than observing new opportunities. The mind becomes crowded, and a crowded mind makes poor judgments. Too many positions also blur accountability. When one trade goes wrong, it is easy to ignore it because another is working. Gains in one area justify losses in another. This balance feels comfortable, but it hides mistakes. Clear thinking requires feedback. Overloading your account mutes that feedback. There is also the problem of timing. Markets do not move in unison. Some require patience, others demand quick action. When you are spread too thin, you cannot give each trade the attention its timing requires. You miss exits. You hesitate on adjustments. You act late because you were busy elsewhere. I have seen traders miss the best opportunity of the year because they were managing mediocre positions taken out of boredom. Their capital was tied up. Their focus was divided. When clarity finally arrived, they were unable to act decisively. Fewer positions sharpen conviction. They force you to choose. Choosing requires judgment. Judgment improves with practice, but only when you feel the full weight of each decision. Too many positions dilute that weight. Nothing feels important because everything feels temporary. The market rewards commitment, not scatter. Commitment does not mean stubbornness, it means clarity. When you understand a trade deeply, you can sit through normal reactions without panic. When your understanding is shallow, every fluctuation feels like a threat. There is a reason experienced traders often appear inactive. They are not lacking ideas. They are filtering them. They know that the best opportunities are rare and obvious in hindsight. They prefer to wait for those moments rather than spread themselves thin across marginal setups. Too many positions encourage constant adjustment. Each adjustment feels productive, but it is often just anxiety in motion. The trader becomes reactive. He stops letting the market work. He interferes, and interference increases error. Clear thinking requires the ability to step back and observe. When your account is overloaded, stepping back feels impossible. You are always in the middle of something. The market becomes noise because you have too much at stake everywhere at once. I learned that concentration is a form of risk management. By limiting positions, you reduce complexity. By reducing complexity, you improve judgment. Improved judgment leads to better timing, better exits, and fewer regrets. The market offers endless possibilities, but your capacity to manage them is limited. Respecting that limit is part of professionalism. Ignoring it is an invitation to confusion. A trader who wants clarity must be willing to let many opportunities pass. He must accept that he cannot catch everything and should not try. When positions are few, thinking is clean, and when thinking is clean, decisions become deliberate.